All right, let's dive right into this explainer. Today, we're unpacking a highly anticipated market event, the Hexagon Nutrition IPO. We're going to literally peel the onion on this one and figure out if this 138.87 crore issue is actually worth your hard-earned money.
Here is our roadmap for today. We'll start by looking at the retail investor slice and the company's status as a niche nutrition powerhouse. Then we'll dive into the bull case for their financials, before uncovering some hidden fine print, like a major promoter exit red flag and some underlying small-cap volatility risks. Finally, we'll wrap it all up with a final retail verdict.
So let's kick things off with Section 1, the retail investors slice.
The burning question on everyone's mind right now is simple. Should you actually jump into this IPO? As a cautious first-time investor, you really need to know if the hype we're seeing is justified by the actual on-the-ground fundamentals. So let's filter out the noise.
First, let's look at the allocation. 35% of this 138.87 crore issue is specifically reserved for retail investors. The barrier to entry here is pretty standard. A minimum investment of $14,985 gets you a block of 333 shares. But, before you go allocating those funds, we really need to understand the machine you're buying into. That brings us to Section 2. What exactly is this business? Well, Hexagon is a lot more than just a local brand. They are a legitimate niche nutrition powerhouse.
They've got a massive global reach. We are talking about exporting science-backed solutions to over 75 countries globally. From Asia to Africa, Europe to South America, they aren't just relying on the domestic Indian market. They've built a truly global footprint in the health impact space.
And how does that global footprint translate into actual cash? Well, they've got a very clever, uniquely diversified three-pillar revenue model. First up is their B2B2C segment, micronutrient premixes, which makes up the bulk of things at 51.5% of their revenue. This is where they lock in recurring fast-moving consumer goods, or FMCG clients. Second, they have a B2C segment, featuring branded clinical wellness products. Think brands like Pentasure and Obesigo. These drive much higher margins thanks to hospital-backed recommendations. And third, there's an ESG segment supplying therapeutic, ready-to-use foods. It's a remarkably resilient architecture.
All right, Section 3. Let's talk numbers, because this diversified model creates a really strong bull case for their financials.
Hexagon's profitability has quite literally transformed. Just look at their core operating margins, their EBITDA. It expanded from a modest 6.2% in financial year 2023, jumped to over 12% in 2024, and hit a very robust 14% in the first 9 months of FY26. They are scaling incredibly efficiently and successfully pushing their product mix toward those higher margin wellness categories we just talked about.
Plus, and for a retail investor, this is usually a massive green flag. They operate with a highly conservative balance sheet, a debt-to-equity ratio of just 0.18. That shows a very healthy low leverage position. Basically, it means the company isn't being crushed by heavy interest payments, making them much better equipped to weather any economic storms compared to their highly leveraged peers.
However, and this is where we need to pull the rug out a bit, let's move to Section 4 and address the elephant in the room, the promoter exit red flag.
You see, there is a massive difference between a fresh issue and a 100% offer for sale, or OFS. In a fresh issue, your money actually flows into the company to fund things like R&D, expansion, and future growth. But this IPO, it's a 100% OFS. That means every single rupee flows entirely to the exiting promoters. Zero funds reach the company's balance sheet. It's kind of like buying a used car where all your money goes straight into the old owner's pocket and absolutely nothing goes toward fixing the engine or upgrading the vehicle.
And the kicker here? The Kalkar family promoters are using this IPO solely as an exit mechanism, and they are reaping massive returns, anywhere from 35 to 93 times their original acquisition cost. Meanwhile, the company itself gets no fresh capital for its future. As a cautious investor, you've really got to pause here. Why are the founders taking so many of their chips off the table right now?
And the lack of fresh capital isn't the only concern. Section 5. Let's dig into the fine print for some hidden small-cap volatility risks.
Buried deep in the risk factors is a pretty glaring operational red flag. Their primary manufacturing hub in Nashak has been hit with multiple regulatory notices. And get this, failure to regularize these issues could result in literal demolition orders. That is a worst-case scenario that would completely cripple production across all three of their revenue pillars.
Then there's the capacity issue.
Right now, their factories are humming along at only about 30% capacity utilization. Now, sure, optimists might see room for growth, but realistically, today it means they are absorbing heavy fixed costs, like machinery depreciation and payroll, on a very, very low production base. If their sales growth stalls out, those fixed costs are going to eat right into those impressive 14% margins we looked at earlier.
Oh, and the headwinds don't stop there. They are facing fierce multinational competition in clinical nutrition from pharma giants like Abbott and Nestle, who have massive marketing budgets. Plus, Hexagon relies heavily on raw material imports from China, opening the door to unpredictable geopolitical and supply chain risks. Top it off with a cooling gray market premium, which tells us the pre-IPO unofficial market sentiment is pretty neutral right now, and the risk profile definitely steepens.
Okay, let's bring it all together. Section 6, our final retail verdict.
It really comes down to a classic tug-of-war. You have to weigh some genuinely strong low-debt business fundamentals in a lucrative, growing nutrition niche against the undeniable reality of an overpriced promoter cash-out that leaves the actual company with no new money to grow.
So, before you go and lock in that $14,985, ask yourself, does the lure of the clinical nutrition boom really outweigh the risk of funding a pure promoter exit? Are you truly comfortable prioritizing capital preservation in a volatile small-cap play where the founders themselves are cashing out? That's the ultimate question you have to answer. Thanks for tuning in to this explainer. Keep asking the hard questions and happy analyzing.